Dear Mr. Crello, thank you very much. Your timing couldn't have been better. That's what we very much appreciate about the real economy. And ladies and gentlemen, let me very warmly welcome Commissioner Hill. You just made it in time. That's a perfect thing. We all know that that timing is what it's all about in life. You obviously have it, and we very warmly welcome you, and we're very eager to learn more about your plans. Welcome.
Well, good morning. It's very kind of you to say that timing is all, but I would like to start by apologizing for being late and express my gratitude to my predecessor for standing in. And I'm sorry that he didn't have the chance to read my speech, that I will do it myself. But it was a good example of the limitation of technology, because the driver put the destination here into his machine, and unfortunately the street names have changed, so I've just had a long, protracted tour of Frankfurt, but it was nice to be able to see a bit more of the city. So I'm pleased finally to be here. One of the things I thought I might be able to bring to the European Union was a British sense of being on time, which I think is something that we share with our German friends. So I apologize that I failed, but I'm pleased to be here, and it's a particular honor for me to be able to speak at a university named after one of Germany's, one of the world's greatest poets. And of course, he was not only a great poet, but also a finance minister. So I like to think that he might have been at home among the gleaming towers that are a symbol of modern Frankfurt's financial success. And Goethe, I'm sure, would have put it more poetically, but I like the slogan that you have chosen for your summit today, and this morning I'm going to argue that we need to have a reality check on a number of fronts. And the first reality check, I think, is on the regulations that we now have in place. Since the financial crisis, we've done a huge amount of work to ensure that we have a safe and stable financial system, one that is robust enough to cope with the challenging times in which we live. And the bulk of our legislation has been drawn up and is now coming into force. And it brings with it better supervision, greater transparency, stronger financial institutions, and a means to deal with problems if they arise. And of course, we now have the banking union, which will help break negative feedback loops between national finances and banks. And I will obviously work hard to make sure that things stay on the right track. So regulation was needed to respond to the threat to financial stability posed by the financial crisis. But today, I think that there is a new threat to financial stability: the lack of jobs and growth. So I think that now is a sensible time to take stock of the overall impact of regulation, in particular the legislation of the last 5 years, and look at it through that prism of jobs and growth. In other words, to carry out a reality check, to make sure that we have got the balance right between reducing risk on the one hand and fostering growth on the other. So with the worst of the crisis behind us, I think we have to be ready to ask, do these rules achieve exactly what they set out to do? And do they do so in a way which poses the minimum burdens? We'll be looking at the laws that have been passed individually through the various review clauses that are already built into nearly all legislation. But I think we should also do it as a whole, because I want to understand the combined impact of our rules and the consequences, sometimes unintended, of interactions between different pieces of legislation. I'm certainly not signalling that I want to throw our hard-fought recent reforms overboard? I don't. But I do think that if on the ground the rules are in practice impeding the capacity of the financial industry to lend and to invest, then we should be prepared to look at them again. In the same vein, I think that we need to be careful to take into account the diversity of Europe's financial landscape, to differentiate in our rulemaking so that rules are proportionate to the risks posed, and to ensure that they take into account different business models, for example, of banks. Now, we've already done this in the Capital Requirements Regulation, where we adjusted some of the rules to recognize that savings and cooperative networks are different. And again, more recently, with the liquidity coverage ratios. And I plan to build on this as we tackle future challenges. Proportionality will be a key principle in our rulemaking. And looking ahead, I also want to provide a greater degree of regulatory stability. I know that businesses need certainty to be able to plan ahead. So I don't anticipate that in future we will see anything like the same volume of new legislation that we've had to see recently. My second reality check is that we need to keep our eyes open to new sources of risk. And that's why I want to bring various legislative files still in negotiation to a swift conclusion, notably on money market funds, on benchmarks and bank structural reform. And it's why I'll be bringing forward new proposals later this year so that we have an effective resolution regime for non-bank financial institutions and for clearinghouses, or CCPs, in particular. There are other potential risks moving up the agenda. Take, for instance, the threat to the financial sector posed by cybercriminals, or our lack of preparedness for an aging population. And if you consider that today there are around 4 workers to support each pensioner in Germany, but by 2050 that number will fall to only 2, then you know that this is a challenge that has to be addressed head on. I think thirdly, ladies and gentlemen, we need to have a reality check on how our economies are actually doing. The forecasts are improving, with the latest ECB numbers suggesting 1.5% GDP growth for the euro area this year, increasing to 1.9% in 2016 and 2.1% in 2017. And this is obviously a positive signal. But we're still a long way from a healthy level of growth or an uptick in the number of jobs, as 24 million people out of work in Europe will tell you. So that's why restoring growth is the Commission's top priority, why our first act was to launch the €315 billion investment plan to support investment in long-term infrastructure projects. My colleague Jyrki Katainen has been making good progress on this. Just last week, EU finance ministers approved the legislation to set up the European Fund for Strategic Investments. I know that Germany has pledged €8 billion to the fund, a sum which has been matched by France and by Italy. I think this is encouraging, and we hope to have the fund in operation by the summer. Now, I believe that this investment plan will help give a welcome shot in the arm to investment in Europe. But if we want it to be more than a one-off, if we want to have a durable impact on economic conditions in Europe, then we need more structural change. We need to remove the obstacles currently standing between companies or projects and the financing that they need, and to increase the range of options available to investors so that Europe's savings, pension contributions and investment premiums can be put to more productive use. And that is in essence what we want to achieve with the Capital Markets Union. Free movement of capital was one of the 4 fundamental principles on which the European Union was built. But over half a century on from the Treaty of Rome, we still don't have a fully functioning single market for capital. The market remains fragmented, largely along national lines. And if we can make progress on building that single market, the prize would be considerable. If we just take one example, if our venture capital markets in Europe were as deep as those in the United States, that could be worth as much as 90 billion euros more in funds. That figure would have been available to companies between 2008 and 2013. Think of the innovation, the new services, the new jobs that could have been created if that funding had been there. I know economists might call that a counterfactual. I tend to think of that as a missed opportunity. So our goal with Capital Markets Union is to make Europe more attractive to inward investment, to create more financing opportunities for SMEs and for infrastructure projects, to spread risk more effectively to those who can bear it, and to open up new opportunities for business across borders, increasing competition. Do we simply want to imitate the American model at the expense of well-functioning bank financing of small businesses, or to promote the City of London? Is this an attack from Brussels on Germany's three-pillar banking system? Are we not encouraging smaller investors to take more risks than is sensible? Well, my answer to those three questions is pretty straightforward, and it is no. Capital Markets Union is about complementing the role of banks, not about displacing them. It's about developing European solutions, not aping American ones. And Europe's banking system will obviously continue to play a pivotal role in Europe's economy. It's very important to local communities, and it's at the heart of capital markets themselves. So I'm sure that many companies will continue to get the bulk of their finance through bank lending. In Germany, we know that bank financing works better than in many other parts of Europe, where SMEs and startups simply can't get the finance they need from banks to grow. But even here in Germany, developing more funding sources could help. Think of the high-potential technology companies that move to the United States in order to have access to a more suitable range of funding options for their needs. There's even a German school in Silicon Valley to cater for the families of all those German entrepreneurs. And as Chancellor Merkel has said, where are the German, the European, Googles, Facebooks, and Apples? So I think that even here in Germany, where bank funding has proved highly resilient throughout the crisis, there are opportunities that are being missed. Now, behind the label of Capital Markets Union, there are a number of pragmatic, incremental steps to get funding to where it's needed most, in long-term investment projects, in infrastructure, and into our SMEs. So if I may, I'll say a word about what I hope to see emerging in the coming years in each of those three areas. I think that getting the market for securitization going again in Europe will make a real difference to long-term investment by broadening the investor base to include more long-term investors such as insurers and asset managers. We want to achieve a differentiation of high-quality securitization products across all financial sectors, indeed to set up a framework for the development of an EU market that singles out a category of highly transparent, simple, and standardized products. This isn't entirely new ground. The detailed rules for Solvency II and the CRR liquidity coverage ratio has already established a differentiated approach for securitization instruments, and we want to build further on this. We're also supporting institutional investors to invest in long-term projects. Much has been written, I know, about the need for institutional investor behaviour to take a longer-term approach. And I don't think personally that it is for governments or indeed the European institutions to try to force such a change. But we do think that there is a role we can play in supporting such developments. For instance, insurance companies were given a number of incentives to invest for the long term in the detailed rules introduced for Solvency II last October. We could also step up efforts to create a single market for personal pensions, which would help mobilise more personal pension savings for long-term financing. As far as banks are concerned, many of the detailed rules implementing the capital requirements take account of long-term finance needs. but we will also produce a report under the review of the Capital Requirements Regulation to assess how appropriate the existing rules are in relation to long-term financing. Private placements also have the potential to offer investment opportunities for long-term investors, and they could broaden the availability of finance for infrastructure projects. A group of industry bodies recently launched an initiative to encourage the development of the European private placement industry, and I very much welcome that, not least because I do not think that we always have to reach for the legislative route as a first option. I think that the Capital Markets Union should also give us a framework within which we could make a difference to our infrastructure, to the roads, the bridges, the broadband networks that connect our continent. It can do this by providing incentives to institutional investors to put their money into infrastructure. And so 2 quick examples of things that we're doing. First, the European Long-Term Investment Funds, or LTIFs, provide a vehicle to provide this type of incentive, both for the new European Fund for Strategic Investment and for insurers. And the European Parliament agreed to LTIFs recently, and I want to see them up and running as soon as possible. And second, the work of the task force on the investment plan will help increase the transparency of infrastructure projects, which should make it easier for investors to identify strong projects in which to invest. And our intention is to make amendments to the detailed rules on Solvency II in both these areas, that is, to make provision for LTIFs and to give insurers more ways of getting involved in infrastructure projects. The third area is helping SMEs to get access to finance. That's not a new goal, and member states have obviously been active in it in a number of areas. Some have already taken initiatives to try to channel funding more effectively to SMEs, and we're looking at the experience that's been gained under those schemes. But if we can get that right, the benefits of doing this at the European level could enable us to generate valuable multiplier effects. We've supported bank lending to SMEs by setting lower bank capital requirements relative to the Basel rules for lending to certain SMEs. We'll also be focusing on SME lending in our forthcoming assessment of the impact of capital requirements. And in the context of international standards, we'll argue that particular attention should be paid to the appropriate calibration of SME lending capital requirements. But banks could help perhaps in one area, namely in giving better feedback to SMEs and pointing small businesses towards alternative types of financing when they consider that a loan is not right for them. Other SMEs, I recognise, may want to have other options, like listing on a growth market or attracting venture capital. And we need to help raise SMEs' awareness of alternative financing opportunities. Companies that decide to take the plunge and offer securities on a market should not be deterred from doing so simply because of the amount of paperwork that is involved. And that's why we want to revise the Prospectus Directive so that it becomes easier for SMEs to fulfill their listing obligations, but in such a way that investors are still well informed about what they're buying. And we've recently launched a consultation on this and look forward to getting practical advice on how we might be able to improve things. Although there is good basic information out there on companies and what they do, potential investors can't easily assess the credit risk that they might present. So we're also going to look at whether there is a way of increasing standardized data for credit assessment without tying all SMEs up in a new tangle of red tape. Finally, we're considering how we could boost the ecosystem in Europe for venture capital. That might include adapting the rules for European venture capital funds and European social entrepreneurship funds to expand the categories of fund managers able to offer these funds. So if I just take those 3 areas, I hope you'll see that what the Capital Markets Union project offers is an opportunity. An opportunity for banks as important intermediaries of market-based funding. An opportunity for investors to increase their options for investment. An opportunity for Europe to widen access to new channels of funding for SMEs and infrastructure projects. An opportunity, in other words, to finance growth. I'd like to end with one last reality check, and it's this. It will not, in my view, be politicians, regulators, and supervisors who will create the growth that Europe so badly needs. That will be done by businesses and companies who innovate, who take risks, who expand into new markets, who create jobs. So what can I do? What can we do? We can help provide the conditions for growth by offering stability and regulatory certainty, by remembering when we regulate that we must be proportionate and always take into account the effect that our rules have on the marketplace. If we really mean it when we say that our top priority is jobs and growth, then that, I believe, is the reality check that we should apply to everything that we do. Thank you very much.